Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little bit of money. My job is not just to entertain, but to teach. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. If people were expecting the Federal Reserve to give us fireworks, they were sorely disappointed. Fed Chief Jay Powell is not giving hyperbole. He's trying to balance price stability with job growth. And right now, the risks tilt against the latter. As Powell told us today, the labor market is really cooling off. So the widely expected quarter-point rate cut made a ton of sense. But the market was all over the place after we got this widely telegraphed news. Dow gaining 260 points, S&P dipping 0.1%, NASDAQ declining 0.33%. It made you feel like the Fed somehow took us by surprise, but that was not the case. The market's reaction tells me two things. One, there are people who actually believe we get something bigger. And two, there are people who think that stocks are overvalued without big rate cuts. Given that Powell said, quote, there wasn't widespread support for a 50 basis point cut today, end quote, we were going to see some sellers. Perhaps there were enough investors out there who thought the Fed would give in to the president and bless us with a 50 basis point cut. Those people are delusional. While we could have gotten more dovish language from Powell, of course, a tad disappointing to equity investors, no big themes were upended, no longer-term gains were put on hold. In the end, everybody with half a brain knew we'd get a quarter-point cut, so it shouldn't have done nothing to the market. If anything, the market's wild action after the 2 p.m. statement and the 2:30 press conference created some interesting buying opportunities. Why is that? Because we around here do not trade cuts in rates. That's not what we do. We don't buy or sell stocks based on statements by Jay Powell. We're not that thoughtless. Of course, we want to see how the bond market reacts, and bonds were all over the map, finishing down in price and up in yield, unfortunately. But it was nothing major, almost kind of back to our regular programming. Almost, because the president's going to hammer Powell for doing so little, so late when he gets a break from some state dinner. So what's changed here? Honestly, not much. Just that people don't like to say that, because that's not newsworthy. First, I think we can stick with technology and with artificial intelligence and the failings of companies that are involved in both. We had something very strange today, a story about how the Chinese government wants a full stop in buying Nvidia's artificial intelligence chips for some of the biggest clients. Those are the ones that are made for China. We thought they'd be welcome there. Very confusing, very fluid story. Now, I have to tell you that the Chinese narrative has become the defining story with Nvidia, and I think that that is dead wrong. There's lots of positions in play here. You could argue that this is a ploy, something that can change on a dime when the president talks with President Xi about the People's Republic. After all, the Treasury won't get its 15% of China AI chip sales if nothing sold. 15% of nothing? Suboptimal. You could argue that Nvidia looks like it'll be shut out of the market that's worth about $50 billion in sales per year. Right now, Nvidia has no China numbers. They're not in the numbers. So don't expect number cuts. That's why I don't think there was a reason to sell here. Me, well, shocker, I say own Nvidia, don't trade it. And if you can get some in at the 160 level, oh boy, I'd be a buyer. Nvidia's at the heart of AI. The new chips that are coming out are way ahead of the current ones. The Chinese government needs to be mindful not to shoot itself in the foot. Other countries will get these chips, which will take AI to levels where it can truly surpass humans in many different kinds of problem solving and surpass all those Chinese companies, too. Nvidia now has the worst case scenario in China. Everyone knows that. I think that's your best chance to buy. Second, as I mentioned yesterday, the banks are still looking good as short rates go down. They borrowed the short end of the yield curve, and then which fell, by the way, because of the rate cut, and then they lend long, which is higher. So when long rates drop and long rates rise, the banks, and when short rates drop and long rates rise, well, I got to tell you, that's when you buy the bank stocks. At tomorrow's noon CNBC Investing Club meeting, I'm going to talk about this. I'm going to tell club members that I intend to stick with the banks, even though we have huge profits. If you don't own any, then still you can buy Wells Fargo, which is stalled here in the $82 range, and you can get even more buying of Capital One if you own some of that, the credit card bank, which will make a fortune now that it's merged with Discover. Very few defaults at Capital One, far fewer than I thought there would be at this point in the cycle. As Jay Powell said, households are in good shape, and that's not about to change. Third, the market turned on the travel and leisure stocks again. Oh, God, they keep doing that. Even as I continue to tell you that COVID changed the industry permanently. Marriott was crushed today, which makes no sense at all, especially when American Express was up 3% to hit an all-time high. Fourth, I don't see any real reason to get excited about the interest rate-sensitive cyclicals, including the housing stocks. Those are the stocks you'd buy if we heard that the Fed had a very serious debate about whether to have a double rate cut. We didn't get that. Now, for instance, we own Home Depot for the Travel Trust. It's been a big winner, and I'm not surprised that it got dinged today down 1%. You need to hear something about bigger cuts to get that stock higher, and it didn't happen. It's going to be slower. It's still going to go higher, though. I don't feel great about the cyclicals in general, even though Caterpillar hit an all-time high today, unless they have something to do with the data center or with aerospace. I'm concerned, for example, about FedEx, which reports tomorrow. 25 basis point cut won't change things in time for this great shipping company. I'm even more concerned about United Parcel with its 7.8% yield. That yield's too high, may not be sustainable, even as management keeps saying otherwise. Fairly or unfairly, when you see that kind of high yield, the stock market is saying don't trust the dividend. Now, there are plenty of critics who will find something that Powell said and try to make it sound controversial. Ginning up stories is what I call it. There'll be some vicious riposte against this man when the president hears what he's done. But the simple fact is that the Fed's caught between a rock and a hard place. We really haven't gotten inflation under control. At the same time, the job market is deteriorating rapidly. At the moment, the Fed thinks the job situation is more worrisome. Besides, the Fed can't beat this new inflation because, well, a lot of it comes from tariffs. Remember, our president wants to ignore that his tariffs are causing the inflation. Powell can't do that. So don't ask Powell to cut rates 5 times. Powell's a reputation for being a prudent person. And that is something that all Fed chiefs want to be known for. We have Powell until May of next year. He'll cut rates further if jobs stumble or inflation comes down or both. But he doesn't want to get ahead of himself because nobody, and I mean nobody, knows what the real impact of tariffs will be, except it's going to be negative. The bottom line, sorry, spectators who wanted something exciting. It's steady as she goes from Powell. And it's, well, if you ask me, exactly what we needed. Spencer, Michigan. Spencer.
Hi, Mr. Cramer. Thank you for taking my call.
Thank you for calling, Spence. What's up?
My question is on Micron. They raised their guidance in August and are heading into earnings next week with stronger revenue and margin expectation. The stock's been on a tear recently. Is it still a buy before earnings?
Okay, here's the problem. Sanjay Mehrotra, is the CEO, is fabulous. He's fabulous. That's one of the reasons why the stock went up so much. But he's also prudent and he's conservative. He may not say the words that Wall Street wants after this big run. I think you wait and see at this point. And remember, again, I have said to you that I like Sanjay Mehrotra, but a stock up 80% year to date, I think that he will be prudent. Dustin in Oklahoma. Dustin.
Booyah, Jimbo. Dustin from Oklahoma. My buddies call me Wit. It's good to talk to you again. I hope you're feeling better. Looking forward to the meeting tomorrow.
Well, I appreciate that. I can't wait for the meeting. What's happening?
My friend, so I got into this stock about 4 weeks ago at $585 cost basis. With the current administration's view on wind and also considering all the countries pouring so much capital into America right now, what is your long-term view on GE Vernova still?
Okay, I don't want you to worry about wind. They've got a lot of, there's a lot of things involved with wind, including maintenance, that makes it so I'm not that worried. And it's a very inexpensive way to power. You don't necessarily need the government. I know it's a negative. The stock got hit very badly when the president came out against wind. But I come back and I say, wait a second. This is natural gas. It's a natural gas story. And every time it is down, I say, buy. So that's what the plan is, okay? Let's go to Naveed in New Jersey. Naveed.
Hey, Jim. How are you doing?
I am doing well. How about you?
I'm great. Just celebrating my wife's birthday today, so I'm very happy.
Hey, happy birthday to her. That's fantastic.
Thanks. Hey, Jim, I wanted to pick your brain on Salesforce. I've been watching this stock. I got into a very large position yesterday. The stock's year-to-date's been beat up. What are your thoughts?
At 21 times next year's earnings, I am beginning to think that I'm not going to pull the trigger on more because the trust has a very small position. I'm beginning to think that the buy case is just much better than the sell case, down 27%. They've got a terrific business. They're everywhere. I think Salesforce is okay to buy if you don't own any. I'll pound the table if it goes even lower. A Fed under Jay Powell is steady as she goes. That's just the way it is and exactly what we need. On Mad Money tonight, shares of Workday pop today on news that Elliott Management is taking a stake in the company. I'm getting all the updates with the CEO. It's a real good story. Then should the Polo Bear rebrand himself to the Polo Bull? I'm taking a look at Ralph Lauren and telling you where I come down the stock. And after a Fed rate cut, it's always good to check in on an economy and the stocks that are driven by it. That's like Ferguson. I'm sitting down with the CEO to get the latest. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Look at this incredible run in the stock of Workday, the enterprise software powerhouse that helps businesses with human resources and financial planning. Like so many other enterprise software plays, Workday's had a tough year. But today turned out to be a very good day for the stock, up more than 7%. In response to the company's annual Workday Rising customer event in San Francisco this week, but also their financial analyst day. By the way, we also got some big AI announcements, an acquisition, a whole bunch of new partnerships, really some fantastic things. And we found out about all of these at the analyst day that was done alongside with their conference. Then after the close yesterday, we learned that the genius activist investors at Elliott Management had taken a big $2 billion plus stake in the company. Unusually, Elliott simply announced a stake and gave a public vote of confidence in Workday's management. I like that. So let's take a closer look with Carl Eschenbach. He's the CEO of Workday. Mr. Eschenbach, congratulations on what seems like a very successful event this week, and welcome back to Mad Money.
Hi, Jim. It's great to see you. Let me apologize. If you see some commotion in the background, it's because I'm coming to you live from our annual user conference, Workday Rising, where this week, Jim, we had over 30,000 people attending live. Record-setting attendance. We took over the streets of San Francisco. You can feel the energy. You can see it. You can see it behind me. You walk around. It's just incredible what's happening. There's something special right now happening at Workday, Jim.
Well, Carl, it's interesting you point that out because even when your predecessor, Neil Bushby, when he had Workday Rising, one time he took me out and he said, Jim, this is not a regular trade conference. We have big announcements. Yeah. We have lots of business that comes with it. This looks like the same again.
Yeah, Jim, no doubt. By the way, at the conference this week, we're celebrating something. Speaking of Anil, we're celebrating our 20th birthday. This marks our 20th birthday here at the conference. And this week, we laid out a really strong, powerful vision in a statement that we are going to be the enterprise AI platform that manages your people, your money, and your agents. And we've rolled out a bunch of announcements around that. First and foremost, we rolled out a number of new agents that are going to drive real business value for our customers, Jim. These aren't just agents that are doing surface level stuff. They're driving business value across people, finance, planning, and industries. You mentioned earlier in your opening, we continue to expand. We continue to expand the platform at Workday, and we had many exciting announcements on stage yesterday, including Satya from Microsoft talking to us how they're going to leverage the Workday platform. We announced a new data cloud solution that's in conjunction with people like Snowflake, Databricks, and an expanded partnership with Salesforce. We announced a new acquisition, a very exciting one that I call inorganic innovation, where we acquired a company called Sana. Sana is going to bring a new, fresh UI UX experience to all of our 75 million customers that are running on the platform around the world. It's been an incredible conference. 75
million customers. Now, one of the things I think people should understand is there's this kind of, you can really help me on this, Carl. There's this big theme, and the big theme is that there's a big AI eating software notion. This is a narrative that basically that AI is going to make it so we don't need a Workday. In reality, I thought your build developer platform answered that objection to owning a stock of Workday.
Yeah, Jim, I think you've talked about it on your show in the past. There's a narrative out there that AI is eating the software world and specifically the SaaS world. And I will tell you that's completely overblown and it's false. Let's start with the first principle of AI. To have good outcome of AI, what do you need, Jim? You need good data to train off of. And for some people, AI may be a headwind. For Workday, it's a tailwind. We have 75 million users on our platform. We have one of the most highly curated sets of data in the industry that we get to train off of. But it's not just the data. We have the context of it. And Jim, today, we have 11,000 customers. We have a gross retention rate of over 97%. We have a sticky platform with all the data, with all the users using it, 75 million strong, that we can train our data and drive real business outcome through our AI solutions. Their narrative is wrong. It's false. And I said yesterday, Jim, and I truly believe this at our investor conference, I personally believe Workday is way underappreciated and we're way undervalued.
Well, it does sound like that Elliott, which is a shrewd judge of things in many different venues and verticals, agrees with you in the sense that when you speak with them, they're saying that Carl's the guy. He's going to get him there. They did favor that buyback. What do you think about the buyback at this, what I think is a very inexpensive level?
Yeah, Jim, we had our financial analyst day yesterday. We laid out a durable growth strategy over the next couple of years that we're very confident that we can achieve. We also laid out a mission to continue to expand operating margins, both GAAP and non-GAAP. And because we believe we're underappreciated and undervalued, we leaned into what I think is one of the best investments we can make, and that is in ourselves, Workday, with a $5 billion buyback over the next couple of years. And to your point, we really enjoy our conversations with our investors, including Elliott. We've had a really good partnership with them over the last couple of years. You saw the last couple of months. You saw the press release they put out last night. And I think they support the narrative that we're underappreciated and undervalued. And when you're working with these type of investors, Jim, you can do one of two things. You can lean into them and treat it as a true partnership and really take their experience and accept their value and their input, or you can push them away. We lean into these relationships, including what we did with Jesse Cohen and the Elliott team.
Well, I'm glad to hear you say that. I have been thinking long and hard. They're basically like a great consultant that you call in, and you can either say, look, guys, you haven't done the work, or you can say, look, I don't necessarily agree, but I know you've done a lot of work. Or you can say, wow, this work is really high quality, and then you take the best that they do. And I think you're approaching it exactly how I think that the stock goes higher with. A very talented investor gets involved, makes suggestions, you adopt some of them because you think they're great, and you work together going forward. That's exactly what you're doing.
That's exactly what we did, and it's not only with Elliott, but it's with all our investors. Sure. We appreciate the feedback. And I think you can see with the reaction to the stock today and the fact that Elliott put out a press release, that's probably not always the type of press release you see from them. But I think they agree with our narrative, our financial framework for the next few years. And we continue to look forward to partnering with them and all of our investors as we go forward.
Well, I thought that you really explained exactly why you are not being eaten alive by AI, because you're integrating AI in a terrific way, Carl Eschenbach, who's the CEO of Workday, coming from what I regard as being maybe one of the biggest trade shows that we don't talk about enough, because it's not really a trade show. It's an explosion of ideas, which is Workday Rising. Thank you, Carl.
Jim, thanks for having us.
Absolutely. Mad Money will be back after the break.
Coming up, fresh off its investor day, Cramer's trying on Ralph Lauren for size to see if the luxury fashion retailer can keep up its recent momentum. Next.
In a year that's been very tricky for most apparel stocks, Ralph Lauren, or Rafe Lauren as my dad used to call it, has been a phenomenal winner, up 33% for 2025, trouncing the S&P 500. Now, this is just the latest leg higher for RL. I recommended this thing after speaking with CEO Patrice Louvet in August of 2023. At the time, the stock was at 122. Now it's about 300. In just the last 3 weeks, ever since Travis Kelce and Taylor Swift announced the news of their engagement while wearing Ralph Lauren, the stock has roared. What can I say? When your brand is hot, your brand is hot. Mazel tov to Taylor and Travis. Oh, and Travis, my research director has you on his fantasy team. He's begging for more touchdowns, although I have you in reality. I mean, I'm begging for more interceptions. But Taylor and Travis aside, Ralph Lauren held an investor day event yesterday, and Wall Street, it didn't love it. When management updated the 3-year financial targets, the stock initially got slammed, down about 5% in pre-market trading yesterday. But then the events got rolling, and this thing rebounded from its lows, finishing the day almost flat. However, it got hit hard again today, falling another 2.7%. Why? Because at first glance, the new financial targets do look like a disappointment. This needs explaining. Over the next 3 years, meaning from a base of fiscal 2025, the 12-month period that ended in March until fiscal 2028, Ralph Lauren expects sales to rise at a compound annual growth rate of mid-single digits in constant currency. The company expects its operating margin to expand by roughly 100 to 150 basis points over the same period, although they also plan to continue making investments in long-term priorities along the way. At the same time, Ralph Lauren will keep returning excess free cash flow to shareholders. They said they'll return about $2 billion through fiscal 2028 via dividends and buybacks. At the moment, they've still got $1.6 billion left in the repurchase authorization, which is almost 9% of the company's market cap. That's a lot higher than usual, by the way, for a fashion company. While Wall Street clearly didn't love the numbers, I thought they were pretty darn good. When Ralph Lauren talked about mid-single-digit revenue growth, that's basically a continuation of what they've already been doing. Now, over the past 3 years, the revenue grew by 4.4% on a compound annual basis. For the current fiscal year, they're talking low to mid-single-digit revenue growth. It was slightly better than what's already been promised for this year, and it was also more or less in line with what the analysts were expecting. Over the past couple of years, Ralph Lauren stock has exploded higher on mid-single-digit revenue growth. Nothing to complain about here. As for the 150 basis points of operating margin expansion, well, that looks good to me too. Ralph Lauren's adjusted operating margin has been a little over the place for the past few years, expanding, contracting alongside the company's investment cycles. But generally speaking, they've gone from around 10 to 11% in the years just before the pandemic to the low teens now. That's terrific. In the last fiscal year, Ralph Lauren's operating margin came in at 14%, and so far this year, it's still on the rise. The company's guiding for 40 to 60 basis points of operating margin expansion this year. Now, the consensus estimate for the company's operating margin, we're focusing it for a second, let me tell you, in 2028 was 16.2% coming into yesterday, which would be more like 200 basis points of margin expansion. So maybe some investors were disappointed. But if you're selling a winner because they promised 150 basis points of margin expansion over the 3 years instead of 200 basis points that you were looking for, I can't do anything for you. What I care about is steady margin expansion. And that's what Ralph Lauren told us we'll get. Investors look for steady margin expansion. They love this to show that a company, one, isn't being brought down by the competition and forced to compete on price, and two, that it's got a moat. This one's got a moat, and that's something you've got to think about. The rest of the longer-term guidance looks fine to me. The buyback plan is basically on pace with the $625 million worth of shares that they repurchased last fiscal year. More continuity. What I'm more interested in is how Ralph Lauren believes they can hit these great numbers. Management continues to emphasize three strategic growth drivers. First, they want to, quote, elevate and energize our lifestyle brand, meaning better marketing initiatives, better customer acquisition, better customer retention, more investment in stores. By the way, they're unbelievable at customer acquisition because they want to drive the core and expand for more, which is mostly about product assortment, continuing to dominate in areas of strength like menswear, while pursuing growth in new areas like women's outerwear and handbags. The last big strategic growth driver is, quote, win in key cities with our consumer ecosystem. This is the one that I've liked the most. See, Ralph Lauren has a list of its top 30 cities around the world, which it has been focused on serving, but the company has now identified its next 20 top cities to go after in order to help sustain the brand's long-term growth. Management gave more color on what it's doing to grow its ecosystem in these cities, including digital efforts that I think are really underappreciated part of the story. They have great digital. During yesterday's investor event, management went on into detail about how their marketing and in-store approach changes from, say, London to Dubai to the Hamptons. And the company also devoted plenty of time discussing their Asian strategy. Oh, boy, is this one good. Asia represents a huge growth opportunity. The label is so well known and well liked there. Management also had a lot to say about Ralph Lauren's core capabilities, including some talk about social commerce, personalization, and even their agentic AI initiatives. Now, I really like their new Ask Ralph AI styling experience. Definitely worth checking out. Putting it all together, I came away from yesterday's investor event feeling pretty darn impressed by what Ralph Lauren's doing. Impressed enough that I'm willing to keep recommending the stock. I like the new 3-year financial targets. The numbers weren't stunning, but they're good enough, and they're able to be they're attainable. Plus, even though the stock's had a huge run, it doesn't feel too expensive. Selling for just over 20 times this year's earnings estimates. Keep in mind, in the aggregate, the S&P 500 trades at almost 25 times earnings. So even though Ralph Lauren is expected to put up nearly 20% earnings growth this year, the stock still trades at a sizable discount to the broader market. Earnings growth for the S&P is just 9%. Ralph Lauren should be trading at a premium. Bottom line, if doing the work, if you're checking into the company's new targets, I'm still bullish on RL. Nothing's changed for me. I bet the stock can keep working its way higher from here. I have said it before, and I will say it again. RL is leaving the competition behind and will continue to do so. I want to go to Kevin in Illinois. Kevin.
Jimmy Chillmeister, how you doing today?
Well, you know what? It's a good day. Good day.
Good day.
I'm sorry.
Good day here. Good day here to long-time loyal listener, first-time caller.
Excellent.
Go Birds.
Go
Hey, the
Eagles.
stock I want to talk to you about today has been a total disruptor in the category. Continues to steal market share. Profits are up 100% year-to-date. International growth, they're really kind of just scratching the surface. They've had numerous upgrades. I think the last one was Goldman Sachs at 72. And they got the hottest new product in the industry with Alana New. And ironically, about the same size as Celsius when it moved over to the Pepsi Group, and we know what happened there.
Okay.
So short-term, long-term, what's your outlook on Celsius?
Oh, my God. I like John Fieldley and Celsius. Yeah, I got this book coming out, and this did not make it into the book. I wish it had. I think this company is doing incredibly well. I like them, and the Chill likes them. The Chill likes them. Let's go to William in home state, New Jersey. William.
Jim, longtime listener. My stock is Lululemon. It's down 57%. Is it safe to maybe start taking a look at this?
I tell you, I stopped liking them when I saw that they sued Costco for a really good product that Costco had. No, I'm not. Look, I think the American people want bargains. I would rather see you own Gap, which is going to be turning around this Athleta. That's where I would go. All right, now, I am still bullish on Ralph Lauren here. And not just because I'm bullish on Taylor and Travis, too. Much more made money at, including my exclusive with building product provider Ferguson. I like growth. They have it. Then yet another high-profile company came public today, but this IPO fell flat. I'm telling you why I don't think it's necessarily a bad sign. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. You know me. At the end of the day, there's nothing more exciting than great numbers. Take Ferguson, the North American distributor of building products ranging from heating, ventilation, air conditioning equipment, waterworks, plumbing, fire protection. Yesterday, Ferguson reported a big top and bottom line beat. Sent the stock up nearly 8% in response. Wow, this thing's now rallied almost 30% year to date. Can it keep running? Let's check in with Kevin Murphy, the president and CEO of Ferguson, to find out more. Mr. Murphy, welcome back to Mad Money.
Thank you for having me, Jim. Great to be with you again.
All right, thank you. I want to start from a little bit 30,000 feet. There are many analysts who only know a company like Ferguson as being boom bust. They don't know what I call secular growth. You've got two themes. You've got this reshoring and you've got data center. These are secular growth stories that makes it so that the vicissitudes are not happening.
Yeah, we've got some good things happening. We've got a balanced business, residential, non-residential, about half and half. And as you said, so many people think of us on the residential side of our business. So many people think of us on the showroom side of our business. But on non-residential, we're a big part of the construction of data center activity in the U.S. The underground water that brings data center cooling materials, the commercial mechanical piping, the industrial valve product, the fire protection inside of it. So we're really proud of the impact that we can make on some of those secular trends.
Isn't it amazing? People, all they do is think about how you got on the electric grid. They forget that you have to be on the water grid, too.
You do. Liquid cooling is a big part of data center activity.
Now, also, I just love what's going on in terms of the reshoring, the new factories that we were in Harrisburg, Kentucky, and there's Corning getting $2.5 billion from Apple. They're more than likely having to call you, the general contractors, to call you. You're the one who handles that stuff.
Yeah, and we're dealing with things from semiconductors to GLP-1 production, biotechnology, general onshoring as supply chains want to become more closely aligned with America. Now, and that's all part of great construction.
Now, how do you know where did your expertise come from for these?
Yeah, we start with the customer. And so we start with that commercial mechanical contractor, the underground site utility contractor that build out America's water and wastewater infrastructure. And we focus on them. And as we got more mature in the business, we started engaging with the engineering firms, the general contractors, and then ultimately the owners, not to bypass that contractor, but to make sure that we had the supply chains right so that we could get the product on time, in full, and get the project on budget.
All right. Now, again, I want to go back to this notion that any of those are really impacted by some events that people are fixated on here. A quarter-point interest rate cut is not necessarily what is going to propel Ferguson to higher levels. What is your expertise and the fact that the growth markets are tied in with you.
Yeah, we'd love to continue to see this large capital construction project build out continue in the United States. And we think the secular trends are there to continue it. And those projects are made quite well for the kind of impact that we can make on construction productivity. The rate environment, if the long end of the curve starts to come down and ease a bit, we'll take the tailwind that might be residential new construction.
Can you do both? Can you do both residential? Right. You do have the ability. Are there enough workers?
That's right. Well, so that's a different story, Jim. If you look at the pressure point that's out there, it really is the trade professional, right? We're seeing more retirements than we are new people coming into the trades. And so for us, that's one of the things that we really advocate for at the grassroots level, at the corporate level. How do we get more people? How do we get more families to have kitchen table conversations with their son or daughter where they say the trades are a great way to make a living, a great way to be an entrepreneur?
Well, look, I'm glad you mentioned this. I'm a proud supporter of Harvard, okay? And I hear that the president might want Harvard to work with trade schools. Well, I remember when I was there, I took summer courses. They didn't have much to do with the stuff that I was majoring in. Why not?
Yeah.
Why not? I mean, who's to say that Harvard can't do a good job at that? I don't think it's demeaning. We got to get away from that.
We got to get away from that narrative that everyone has to go to university for a traditional education because, quite frankly, you talk about durable careers. Those are durable careers in the face of AI. And they're also great entrepreneurial ventures as well.
Well, that's what I was thinking. These are businesses. And the same business stuff that you learn at Harvard Business School is applied to a three-shop plumber.
No doubt about it. No doubt about it. And for us, we want to see more people get in the trade so that we can expand that workforce, we can get the work done. But then we live and die with how do we make sure that we add construction productivity to that trade professional? That's how we add value. That's how we grow.
Okay, so Mr. Powell today was very good about and one issue that people don't talk about much, not enough spare land. Yeah. He was saying that it's zoning, that there are issues. You do lots of residential. Is it true we just keep building farther and further out and they become less attractive?
Yeah, if you think about lot development and what the cost of lot development is in those local areas, that's one of the issues that we got to get at around affordability. Because we can talk about rate all we want. We've got to get at housing affordability. And we got to get at speed because we're underbuilt by 4 million units in this country.
Incredible.
Average housing stock's 40 years plus old. We've got to get after taking care of that housing shortage.
Okay, so tell me about when you see Oracle wanting to build all these data. I mean, Oracle's just talking about things that, $450 billion backlog. Are you going to be included somehow in that $450 billion backlog, do you think?
Yeah, it's the biggest part of our growth inside that non-residential activity. We grew our non-res business 15% in the quarter. That was a big driver. The backlogs that we're building are around that data center construction, biotechnology, pharma, onshoring, reshoring. And some of these projects are sized that we've never seen jobs this big. And it's just exciting to be part of what is really a renaissance in America.
I think there are probably people wondering, well, hold it. Can I just do it myself at Home Depot? You're talking about much bigger projects.
It's a very different. Our specialized professional is building out that miles and miles of piping systems that are used to cool that data center. And then we're also engaged in what the energy production that's going to fuel that, what the water production is going to fuel that cooling system. So it's really exciting to be a big part of that.
It really is. I've got to tell you, there's a lot of little guys, there's a lot of little companies that are between, I'd say, 1 billion and 5 billion that people call on the lightning round. And I always say, just buy Ferguson, because not just because I don't know them, but I want someone who's not going to screw it up.
Yeah. What we are trying to be is that scale player, a $30+ billion revenue company with 1,800 locations across the network, but with best local relationships, taking care of local contractors as best we can.
Well, that's why you're winning. That's why the stock's up 30%. Congratulations to Kevin Murphy, President and CEO of Ferguson Enterprises. Guys, this is the one. When you want infrastructure, stop overthinking it. Just do Ferguson.
Thank you, Jim. Thanks for having me.
Everybody's back into the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round question about rapid roll. And the stock set by sell. So jumping into the caller's question. Play this out. And then the lightning round is over. Are you ready? Ski, dash. The lightning round Cramer's brother. Start with Arthur in California. Arthur.
Booyah, Jim. How are you?
I am good, Arthur. How you doing?
Okay. A second-time caller and a second-year club member.
All right. Thank you for me. I hope you be at the meeting tomorrow.
Okay. Yes. My wife and I, we always get positive results from your advice. So keep up the good work. And
thank you. You're very kind.
Right now, we want to ask you about this company. It's a storage company. They're not AI yet, but I think they're essential to AI. And they're reporting next month. Company name is Seagate.
Okay, I'm torn about Seagate. I've known the company forever, from when it was started. Here's my problem. It sells at 20 times earnings. It's the number one performer. I think it's like top 3 performer in the S&P 500. But at 20 times earnings, that's a lot for a storage company. So I would be careful not to buy it at this high point. It's just had such a big run. See it tomorrow on the conference call. Let's go to Clancy in Connecticut. Clancy.
Go Birds!
You go Eagles. What's up?
All right. I still don't make a move without you or the club's input. Could you please
thank you.
Wilton Group?
Wildan outsources. You know what? It's just another outsourced company. I don't mean to slam them. I find nothing all that interesting about the company. Doesn't mean it can't be bought, but I am not that intrigued by it. How about that? Let's go to Dylan in Connecticut. Dylan.
Hi, Jim. Thank you for taking my call.
Of course.
I would like your thoughts on Rubric Inc., ticker RBRK. The company posted great
I
earnings
thought the
results
last quarter was good. The stock got hit on the quarter. Maybe I'm not the call on this. I didn't think the stock should have gone down, so I like it, and I think you're okay. Let's go to Diane in North Carolina. Diane.
Hi, Jim. I'm calling
Diane.
about I'm calling about EXP. I've had it for a while, and I know they have a big presence in the U.S.
EXP. Eagle Materials. No. We don't want Eagle Materials. We would take OC before that one. And, of course, we could always buy Home Depot. And I think that those are better. Let's go to Jose in Illinois. Jose.
Hey, Jim. Thanks for everything you do. What are we thinking on Cleveland Cliffs?
We're thinking on Cleveland Cliffs that it's had a nice little run here and that we want to be in Nucor. Why do I say that? Because I love the balance sheet. I love the expansion plan, Nucor. And I think that it's a little less levered to autos, which is good. Let's go to Minaj in Pennsylvania. Minaj.
Hey, Jim. I'm a long-time listener and a first-time caller. Love your show and thank you for taking my call.
Of course. Thank you for calling.
Okay. I'm calling to get an advice on this German tech giant for enterprise solutions and cloud. It has been going down for some time but recovered last 2 days and closed to at above 261. Is it a buy? Your thoughts on target and time frame? You must have guessed it. SAP.
Okay, I'm caught here. Christian Klein delivered a great quarter. I think that this stock is just, I'm going to say it. I would buy SAP right here. I really would. That was a good quarter. Let's go to Don in Texas. Don.
Hi, Jim. How are you today?
I am good, Don. What's up?
Well, I want to ask about a trust portfolio stock that hopefully is due for a breakout. What is your projection for the timing and the magnitude on the stock price for DuPont?
I'm beginning to wonder whether it doesn't have to wait till the November split off. I mean, I really think that that's what's happened. It's in split off hell. I mean, the stock can't get any mojo. It's doing incredibly well. Lori Koch is terrific. I mean, this thing is driving me batty. But I am not going to sell it just because I'm being driven crazy by it. I got other things to do. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, after another big week of companies going public, Cramer's weighing in on the state of the IPO market, seeing if it's strong or clouded with froth. Next.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock.
As a rule, I don't root against IPOs. I don't want to root against anything that could potentially make you a lot of money. Man, I do despise froth because where there's froth, there's soon to be losses. That's why I didn't mind what happened to StubHub. The online ticket seller came public at $23.50 today and then saw its stock fall below its offering price by 1:15 p.m. It finished the day at $22. Ouch. Look, I'm not picking on StubHub. I actually use them to get tickets wherever I go, including Wembley, to see the Eagles play the Jags in a previous decade. I'm a fan of StubHub, but I'm happy to see this IPO fizzle because it will help curb your enthusiasm. Right now, we need a little curbing. I could say the same thing about Gemini Space Station, the ridiculous name for the crypto outfit founded by the Winklevoss twins 11 years ago. After a 14% gain on its first day of trading last Friday, the stock has now fallen well below its $28 offering price. Again, I'm a client, and I greatly appreciate their pioneering work in telling everyone and everything about crypto. It's great. It's been a fabulous run. Not so for their stock, but that's okay, too. See, it's vital that the IPO market calm the heck down. When we get parabolic moves in newly minted stocks like Figma, which launched at 33, quickly went to an intraday high of 142, I was sick to my stomach. It's why I went back to my old days of shtick and crushed a box of Fig Newtons. We know that the people paying $142 for Figma had no idea what they were buying, a web-based collaborative design platform, because if they did, they'd never, ever pay that much for it. Even now, Figma's stock has come down to $54 and change. You're still talking about a price-to-earnings multiple of 178. That is just plain nuts. The house of pain. Figma's not alone. Bullish, another crypto exchange, this time a digital asset platform, saw its IPO price at $37, then it rallied to $118. It's now back down to $54. Circle Internet, another crypto play. They have a stablecoin. Came public at $31 and rallied to $103 and then charged all the way to $298. Are you kidding me? Before falling to $131, where it is now. And I got to tell you, it is still way too high. The moves in Figma, Bullish, and Circle Internet were all unsustainable. I'm not going to mince words. If this action were to continue, I would have no choice but to say that we are indeed in a bubble, and it is going to end horribly. I say that because I lived through the dot-com bubble, so I'm determined to get people out of the market if new IPOs keep trading to insane levels like they did back then. I'm bullish on this market, but I'm not a perma bull, people. I won't ignore Bullish and Circle and Figma anymore. I will shout from the rooftops that we must all take something off the table, if not a lot of it, if that had continued. But you see, StubHub and Gemini told me that we might be able to avoid the IPO apocalypse. They know nothing! If people bought these stocks at the highs, they no doubt feel chastened. It will make people realize that stocks are risky assets and they can lose a lot of money if they chase something to the stratosphere. The broader S&P 500 with the price earnings multiple of 25 times next year's earnings isn't all that outrageous. There are plenty of stocks that may be selling at low levels versus where they go. If interest rates if interest rates go lower. We don't know about that. What's going to happen yet? But it was the IPO market, not the regular market, that was getting frothy. If that froth is fizzling away, we're in better shape than we were just a few weeks ago. I like to say, there's always bull market somewhere. I promise I'd find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.